To kick things off, welcome to our guide on protecting an inheritance from taxes. Right away, you should know that most heirs owe zero federal tax on what they receive. The big picture is that inheritances are generally not treated as taxable income by the IRS. In this video, we'll unpack what is and isn't taxable, how the stepped-up basis works, when retirement accounts are a trap, and what planning moves help you keep more of your windfall. Let's start with an agenda so you know exactly what's coming. Next, here's the roadmap. We'll cover the overall tax landscape, why federal estate tax rarely applies to heirs, how the stepped-up basis works for assets like homes and stocks, and the critical differences when you inherit retirement accounts. We will also highlight state-level taxes, walk through planning strategies to manage your income and eligibility for benefits, and conclude with a practical action plan. Along the way, we'll test your knowledge with quick quizzes and end with key takeaways. Before diving deeper, a quick but important disclaimer. This video is for educational purposes and does not constitute tax, legal, or financial advice. Tax laws change frequently, and state rules vary. Therefore, you should consult a qualified tax professional, CPA, or estate attorney in your jurisdiction to obtain advice for your specific situation. With that clarified, let's move to the good news about inheritances at the federal level. Now that we're underway, here's the big picture. Generally, inheritances are not taxable as income to the beneficiary under federal law. If there is any federal estate tax due, it applies to the decedent's estate and is settled before distributions go out to heirs. Practically, this means cash you inherit is typically tax-free to you. The estate tax only kicks in at very high multi-million-dollar thresholds, so most estates never owe it. The pie chart is illustrative and not statistical. It simply shows that, in most common situations, heirs do not pay federal income tax on inheritances. With that foundation, let's explore your biggest built-in advantage: the stepped-up basis. Moving forward, the stepped-up basis is often the single most valuable benefit of inheriting assets like a home or a stock portfolio. The cost basis is reset to the fair market value on the date of death, effectively eliminating capital gains that accrued during the decedent's lifetime. If you sell shortly after inheritance, any taxable gain is typically small because sale price and date of death value are close. Moreover, gains on inherited property receive long-term capital gains treatment no matter how long you hold it. Only appreciation after the date of death is taxable to you. Next, let's visualize the timing around a potential sale. Continuing our journey, this timeline emphasizes that the basis resets on the date of death. From that point forward, market movements create the only gains or losses that matter for your taxes. If the market rises and you sell later, the difference between the sale price and the date of death fair market value becomes your capital gain. Conversely, if you sell below the fair market value, you may realize a capital loss subject to standard rules. Throughout, your holding period is treated as long-term. With that context, let's address the major exception to this happy story: inherited retirement accounts. On the other hand, inherited retirement accounts are treated very differently. Traditional IRAs and 401(k)s are typically taxable as ordinary income when you take distributions. Those withdrawals add to your modified adjusted gross income, which can affect your eligibility for Roth IRA contributions, ACA health insurance subsidies, and potentially Medicare income-related surcharges later in life. Many non-spouse beneficiaries are required to empty the account within 10 years, with additional required distributions in certain circumstances. Crucially, there is no stepped-up basis that eliminates tax on pre-tax retirement funds. Next, let's quickly address state-level taxes that can surprise heirs. Additionally, a few states impose inheritance taxes directly on beneficiaries. The list here is not exhaustive, and rules vary by relationship to the decedent. Some states exempt spouses and lineal descendants, while taxing other classes of heirs. Maryland is unique in having both estate and inheritance taxes. Iowa's inheritance tax has been phased out for recent years, but you must always verify based on the date of death. Because state laws change, and details are nuanced, consult a professional in the relevant state. Now, let's turn to planning moves that help you manage income and eligibility thresholds. Furthermore, effective planning focuses on documentation, timing, and income coordination. First, secure accurate date-of-death valuations for all assets to establish your stepped-up basis. Then, coordinate when to sell to control the post-death gains you realize. For inherited retirement accounts, map out a multi-year withdrawal plan to manage your modified adjusted gross income and avoid crossing thresholds that could disqualify you from benefits or impose surcharges. Also, follow required minimum distribution rules where applicable. Importantly, avoid rushing into sales before you fully understand the tax picture and your financial goals. Next, let's compare how taxes differ across the most common inheritance types. As a transition, it helps to contrast categories. Cash is straightforward. It's not taxable federally as income to the heir and requires minimal complexity beyond safeguarding the funds and planning their use. In contrast, inherited investments in real estate benefit from a stepped-up basis, meaning only post-death appreciation is taxable at long-term capital gains rates. However, these assets demand more documentation and strategic timing. Retirement accounts are the most complex. Withdrawals are ordinary income, increase modified adjusted gross income, and are governed by distribution rules, often including a 10-year window. Understanding these distinctions guides your next steps. Now, let's turn your knowledge into an actionable checklist. Consequently, a structured first month can prevent expensive mistakes. Gather key documents, contact financial institutions to retitle assets, and obtain formal date-of-death valuations. Avoid selling immediately until you confirm cost basis, transaction costs, and market conditions. For retirement accounts, create a multi-year distribution plan that controls your modified adjusted gross income. Verify whether any state inheritance taxes apply, based on both the decedent's and your state. Finally, schedule time with a CPA or attorney to confirm deadlines, including potential required distributions and filing requirements. With that in hand, let's test your understanding with a quick quiz. Now for our first quiz. The question is, you inherit a stock portfolio. Which gain is typically taxable to you if you sell? The options are A. All gains since the decedent first bought the stocks. B. Only gains after the date of death based on stepped-up basis. C. No gains are taxable. Or D. Only dividends received by the decedent. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Next up, the correct answer is only gains after the date of death based on stepped-up basis. The cost basis resets to fair market value at death, so only appreciation occurring after that date is taxable when you sell the asset. Let's proceed to one more quiz on retirement accounts. Continuing, here is the second quiz. You inherit a traditional IRA as a non-spouse beneficiary. How are withdrawals taxed to you? The options. A. Tax-free because it's an inheritance. B. As long-term capital gains. C. As ordinary income in the year withdrawn. Or D. Only if you sell investments inside the IRA. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Accordingly, the correct answer is as ordinary income in the year withdrawn. Distributions from an inherited traditional IRA add to your taxable income for that year and count toward your modified adjusted gross income. This can affect eligibility for certain tax benefits, so timing matters. With the quizzes complete, let's crystallize the key takeaways. In summary, remember these points. Cash inheritances are not taxable as income at the federal level. For assets like stocks and real estate, the stepped-up basis is powerful, eliminating pre-death gains so that only appreciation after the date of death is taxable. Inherited property receives long-term capital gains treatment. Retirement accounts are the exception. Distributions are taxed as ordinary income and increase your modified adjusted gross income, which can influence other benefits. Finally, a minority of states impose inheritance taxes, so verify your state's rules. Now let's wrap up with a concise summary and your next steps. To conclude, do not panic. Most heirs do not owe federal income tax on inheritances. The stepped-up basis eliminates pre-death gains and leaves only post-death appreciation taxable when you sell. Retirement accounts are a different category. Their withdrawals are ordinary income and influence your modified adjusted gross income. A handful of states do tax beneficiaries, so verify your exposure quickly. Above all, proceed methodically. Document valuations, time sales thoughtfully, plan retirement account withdrawals across years, and confirm details with a professional. Finally, here's our sign-off with a request to stay connected. Before we part, thank you for watching. If this video clarified your next steps, please like it, share it with someone who just received an inheritance, and subscribe for more practical guidance. In the comments, tell us what part of the inheritance process you find most confusing, or which topic you want covered next. Your feedback shapes future videos.